The last couple of lectures that we've had, we talked about GDP. We talked about the gross domestic product being the total market value of all goods and services that are produced in a period of 1 year. We took that step a little bit further. We developed what we call the expenditures model, which was that GDP is equal to consumption, investment, exports, and government. And with that, we developed a particular model, and that we said that those particular expenditures from those groups of people had to equal the total income that was brought in by the number of people that provided land, labor, capital, and entrepreneurial ability. We very briefly said that was dictated to us in wages, rent, interest, and profit. And again, there are some other national income accounting items that you are responsible for reading on your own. We then went into unemployment, and we talked about the various types of unemployment that we always have, frictional plus the structural, and we talked about the business cycle. We said that the business cycle was primarily a function of the level of spending that people do. The more spending that people provide into the economy, the more money people spend, the higher the GDP will be. If people are not going to spend for a variety of different reasons, that would specifically mean that GDP would be low. And to do that, to take this to the next step, we want to talk about some very basic macroeconomic relationships. And to do this, we're going to just to review for a moment the expenditures approach of GDP. The expenditures of approach to GDP was consumption, C, I is investment, X is exports, and G is government. For our initial analysis, we're going to assume that we have no government, and therefore there are no taxes. We're also going to assume that we are a closed economy and therefore do not allow trade. So therefore, if we take out the idea of government and exports, we now have the idea that our GDP is actually just a function of our consumption and our investment, the investment that is done by businesses. And we're going to specifically just include that as plant and equipment. Earlier, we went back to say that for every dollar we spend on a good, if we go back to that chapter on GDP or that lecture on GDP, we said that for every dollar that you spend on a good or service, that in fact becomes income to those people who help provide that good. So therefore, our expenditures approach of GDP, in this case C plus I, consumption plus investment, must equal the income provided by those people who own the resources, land, labor, capital, and entrepreneurial ability. So in essence, by doing that, we can simply say that since the expenditures approach must equal our income in GDP, then our income, in effect, was also equal to the amount of money people spend and the amount of money businesses invest in plant and equipment. So in this case, we can say GDP is equal to consumption plus investment, or C plus I, or we can say that our income is also equal to consumption plus investment. I'm starting to use the uppercase Y for income. It's a little less cumbersome than writing income out. So it's a convention that we use, and therefore just be on the alert that Y stands for income. If we take a particular model that's presented to us, it's the same model that's in your book, at least in the current edition of McDonald, the 18th edition, we have a chart, and where we have in the first column the level of output, which is also equal to the level of income. At the first level, we're providing $370 billion, I guess it is. For purposes, we'll just say 370. For $370 worth of goods and services, and therefore we are providing $370 worth of income. At this particular level of output and of income, according to the chart, we spend $375. So we're actually spending more than the income that we bring in. S stands for savings. And if in fact we are consuming more than our income at this particular level, we would be doing what is called dissaving. Not only are you not saving, but you're spending more than your money, than your income will allow. So in this case, you're spending $375 with an income of $370. You're dissaving by 5. And our average propensity to consume, our average propensity to save is simply our total consumption, which is $375, divided by our total income, which is $370. This will be 101, and obviously this is a negative 0.01. These two must equal 1, just as all averages basically have to. When we decide that we are going to provide more goods and services to the economy, our GDP, our income goes up to $390, meaning that we're spending $390 worth of goods and services, providing income to those who made those goods and services at $390. We are consuming all of our income. We are saving 0. Our average propensity to consume is 1. And obviously, since we're not saving, our average propensity to save is 0. When we talk about the propensity to consume, when we talk about the propensity to save, propensity simply means the desire, our average desire to spend or our average desire to consume. And you can see how the chart goes up at an increase of $20 billion. We are now generating $410 billion worth of goods, generating $410 billion worth of income. Out of that, we are spending $405 billion. We are saving $5 billion, the difference between these two. And our average propensity to consume goes down because we now have positive savings of 0.01. We can see this on our chart, on the graph. If we assume for a moment that this particular line, this red line, if you can see it on the camera, if this red line is our income line, and our income line is growing in a steady fashion, which most incomes generally do over time. At the earlier parts of our life, if you want to think of it that way, at earlier parts of our life, you're consuming more than your income will allow. You may be in that situation right now where you have student loans, you have education, you have a job that perhaps might be part-time and is not as fulfilling, as financially fulfilling as the job that you want to get once you graduate from Wilmington College or what have you. So your expenses are higher. You have your mortgage and what have you. Your expenses could be higher than your income, and therefore you are dissaving. Perhaps you're drawing down on some of your assets. However, as time goes on, at some juncture, your income will equal your income, and at points beyond this, your income is greater than your consumption. So now you are savings, and we can see this correlation down on our savings schedule. If we take a look at this, and if this is our GDP, our income, at the earlier stages, from here to here, we are dissaving, and over here we're saving, which is simply the distance between these two.